Good morning. These are the things that matter most in Europe's market today. The AI trade is still setting the global tone. Oil and Middle East risk are keeping rate cut hopes constrained. Shell has turned the energy story into an earnings quality test. And one underappreciated UK story is that water utilities are still a credibility risk for defensive infrastructure. The question for private investors is simple. Can Europe reward earnings strength if the market also has to price fuel costs, inflation anxiety, and crowded technology expectations? Start with AI and European technology. Big tech earnings in the US showed that AI spending remains enormous, and the BBC framed the week around what investors learned from AI in major technology results. For Europe, the read-through is not a simple theme-chasing signal. ASML, SAP, and Infineon each sit in a different part of the chain. ASML needs confidence that chip equipment demand remains durable. SAP needs AI to strengthen cloud growth without hurting margins. Infineon needs the cycle to broaden beyond the narrow data center winners. Winners are companies with visible demand, pricing power, and bottleneck value in the AI supply chain. Pressure sits with high multiple technology and semiconductor names where expectations already price in perfect execution. For private investors, the practical takeaway is that AI can still be important while the market becomes much more selective about who actually earns from it. Second, rates in oil are now joined at the hip. The Bank of England kept interest rates at 3.75%, while both BBC and Guardian coverage emphasized that inflation fears and Middle East risk are limiting the room for easier policy. That matters for Europe because a higher oil price does two things at once. It can support energy companies, but it also raises the cost base for airlines, transport, chemicals, and consumers. Potential beneficiaries are large integrated energy names, cash-rich companies, and banks if the rate backdrop reflects resilient growth rather than inflation stress. Pressure sits with Ryanair, IAG, Lufthansa, BASF, Covestro, and other fuel or energy-intensive names if the crude move becomes a margin tax. The useful filter is not simply risk-on or risk-off. It is whether oil strength leads Europe or quietly tightens conditions under the surface. Third, Shell puts energy earnings back into focus. BBC reported that Shell profits doubled as oil prices rose due to the Iran war. That turns the energy story from a headline about crude into a question about cash conversion, buybacks, balance sheet strength, and political pressure around North Sea investment. Shell, BP, and TotalEnergies can benefit if crude stays firm, but the market will still test whether profits are durable or just a one-off geopolitical windfall. Winners are integrated energy companies with strong cash flow, disciplined capital spending, and resilient refining or trading support. Pressure is on names where political scrutiny, windfall tax risk, or weak downstream margins offset higher crude. For private investors, the takeaway is that energy strength needs earnings quality, not just a rising oil chart. The underappreciated story is UK water and infrastructure credibility. Thames Water's boss said leakage targets are not realistic, according to BBC coverage. That may look far away from the morning equity tape, but it matters because defensive infrastructure is supposed to be predictable. When essential assets face regulatory pressure, funding stress, and public trust problems, the market may demand a higher risk premium even for sectors that usually look defensive. Winners are regulated assets with credible financing, operational delivery, and political trust. Pressure sits with utilities and infrastructure names where debt, regulation, or service quality create headline risk. For private investors, the takeaway is that defensive does not mean risk-free. In Europe, infrastructure quality now has to be proven, not assumed. Here is the stock-led watch list. ASML, SAP, and Infineon. Does AI spending support Europe's technology chain, or does valuation discipline dominate? Shell, BP, and TotalEnergies. Do oil profits lead the tape, or does political and margin scrutiny cap the move? Ryanair, IAG, Lufthansa, BASF, and Covestro. Does fuel and input cost pressure show up in the weaker side of the tape? Severn Trent, United Utilities, and broader infrastructure names. Does defensive infrastructure maintain trust, or does regulatory risk keep rising? Market bias, selective, inflation-sensitive, and proof-driven. Europe has clear potential winners, but the market is not rewarding every big story equally. The mistake to avoid is treating oil, AI, or defensives as one simple basket. Today's better filter is confirmation. Which companies show earnings quality, margin resilience, and balance sheet credibility, and which ones only share the headline label? That is the Europe Morning Market Brief. We will be back tomorrow with everything that matters. Research context only. This briefing is not investment advice.